That was really an excellent panel. Thank you so much, Vincent, and thank you to the panelists. Sorry, guys, trying to keep the time is never easy, so I apologize for being the policeman of time. Never a good idea to have a Greek policing the time, but anyway, after being almost 40 years in America, I think I can be tougher on that. Let's have the next panel with our friend Woon Kim from Vedder Price. He will take us through the world of global bank financing, and I can see the panelists walking over, James and Nicolas. And where are the rest? And Darryl.
Good deal. Let's get this party started, eh? All right. For those of you that don't know me, my name is G. Kim. I'm a shareholder at the law firm Vedder Price based in Singapore. It's my pleasure to join you this afternoon and moderating this panel. I think we've got a fantastic group of folks here who will share their thoughts from the banking side of what's of the current state of the market, as well as some of the thoughts that are going through their through their companies. Let me just introduce you very quickly to the panel, and we'll get started here. To my immediate left is Mr. Darryl Tan, Head of Transportation Logistics, Asia Pacific at ABN AMRO. Next to him is Mr. Logan Chong, Managing Director, Transport Sector, Investment Banking Asia Pacific, BNP Paribas. Next to him is Mr. James Tong, Managing Director, Head of Asia Pacific and Japan, Global Shipping Logistics, and recently Head of Diversified Industrials in China at Citi. Next to him is Mr. Nicolas, Duran, Director, Corporate Finance and Partner at Fearnley Securities. And last but not least, Ms. Maureen Xiang, Director of Standard Chartered Bank. All right. So I was looking at some recent data that's come out in the market on the shipping finance by the banks. And based on some recent numbers, at least for 2019, the first quarter, it looks like year to end, the volume of business may be slightly below what we've seen last year. It's slightly below also the historic average. Not sure if we can conclusively make any sort of statements about what the market is like for the banks after just one quarter. But looking back at 2019, it contrary to what may be a popular view in light of some of the bigger press with certain banks leaving the market, not doing the traditional financings anymore. Perhaps that's a lazy view, but it would be good to hear from the panel this afternoon their thoughts and what the current market state is like for the banks, because deals were being done in 2018, albeit it may have been at more expensive cost, and certainly in the market in general, financing market, we do see a lot of alternatives out there. It's gotten to be such a prevalent part of the market now that we can stop calling them alternatives, but they are part of the financing world as we know it in the shipping sector. So, clearly there's less total commercial bank debt because of the exit of certain banks, but I like to think maybe the situation isn't as bleak or dire as it may seem to be from a cursory view. So we'll expect to hear some thoughts on that this afternoon. As I said, the traditional banks are doing deals. I think we've seen them. But perhaps when you're not talking about the highest credits, where that's very competitive and the competition is fierce, I think we can all attest to that. But there have been some creative deals that were done by some of the banks, whether it was managing the upfront cost, or maybe the amortization profile may have changed a little bit. So hopefully there's an appetite for a bigger array of borrowers that can make use of the bank market. So on that sort of introductory note, I will ask for the panel's thoughts. Sort of your appetite and capacity for lending today versus perhaps last year, even compared to the first quarter of 2019. Darryl, you want to start us off here?
Yeah, definitely. Thanks, G. ABN AMRO has been involved in shipping for many decades now, and the shipping industry is it's one that is important for the bank. We remain committed to the industry and also to our clients, and we'll be very keen to use our capital for clients. But what we see, despite not the lack of appetite, was like you pointed out, there was much less activity compared to 12 months or 18 months ago. So while we are very much in the market, we see also that there are much fiercer competition also from the alternatives, like you said. But we still continue to be a financial partner to all our clients. And I think for the years and decades that come, so we will continue to be there.
Logan, your thoughts?
Yeah, BNP, we have done shipping for more than 50 years, so we are quite consistent. Every year we increase our book. Fairly speaking, that we do not see really the market is slowing down. Yeah, our deal flow is still very strong. Although there are some banks not doing shipping anymore, but we see that the market funding is still sufficient, but maybe due to the shipping market because of the bulk carrier sector and the trade war. So ship owners, they're more conservative. That's why the demand from ship financing may be not as great as last year. But because supply imbalance and less bank doing shipping, so we see the deal flow is still very much the same as last year. In fact, frankly speaking, we can have a chance to select our clients. Yeah. And unfortunately, BNP, we are a very conservative bank. So our target client list is, target market is still the top tier, second tier, and also, but it doesn't mean that we not target any private ship owners. We have a lot of private ship owners clients in Hong Kong, in China too. But we need to really look at their history, their reputation, their credibility to follow. Yeah. Thank you.
James, your thoughts?
Good afternoon, everyone. 大家好. In my view, I think most of the banks will still be doing shipping finance, but then is a little bit devil's in the details. There will always be relationship banks helping their existing clients to look for sourcing for different financing. I think, in fact, the volume has shrunk for sure. Various reasons, banks are leaving, and also there are new entrants to the market. But I think it is important to give a message that not to give a wrong message to the public that they could order ships and expecting there will be shipping finance that easily. But in fact, since I moved to China, I've noticed that there's a shift of the shipping finance again now. In the old day, it was captive and then become individual ship owners. Nowadays, we see more cargoes owners come to the market to buy ships because they do have a cargo. So from that perspective, they should be able to get the financing because I think in the past, a lot of capitals have been invested into ship owners, and a lot of them might not necessarily cargo owners that create a speculative markets in there. I think it is good to have capital dried up. At the same time, we see a lot of leasing company coming into the market, which is a very good substitute. But at the same time, I also see competitions among the leasing companies too. I think it is important to think about what Dr. Martin Stoffel talked about, the environmental issues in here. And I think there will be lots of green ships coming out into the market. And they are relatively more expensive at the moment, but I see that one of the Malaysian clients that we see, they have ordered the first dual fuel tankers, which is almost double the price in the normal market price. But they have secured long-term contract from the oil major. Because I do believe that these type of expensive ships now, but green ships will have the market. At the same time, we see a lot of green funding coming into the market to look for the right ships because it cannot wait anymore. The environmental issue is a imminent issue. Next year there will be Poseidon Principle is going to come out to the market as well. That will actually dictate the banks how to sign to become a responsible financier. I think this is the part that all change it. If we are not preparing ourselves, I think that is something that if you guys still continue financing the same type of ships, same type of financing, I think that would be where the loss is going to be incurred for lenders. So I think it is a healthy market now not to have a lot of volumes, in fact, and while focusing on the right ships, right clients.
Nicolas?
Yes, thank you. So I think we at Fearnley Securities can maybe offer a slightly different perspective, not having any money to lend out because we're an investment bank and not a lender in that sense. We think that it's obviously good for our business as arrangers of high-yield bonds, secured and unsecured, lease financing, etc. It's good for us that the banks are maybe not as active and much more selective, certainly, than they've been before. I think others have spoken earlier today of a very clear flight to quality. So there's very strong downward pricing pressure for a select few owners. So that's good for our business. On the other hand, I'm a little bit concerned that with shipping being such a fragmented business and the lacking availability of traditional, low margin debt to so many owners means that there will most likely be a kind of ceiling, or there will be that will act as a damper on the asset values. And for us as an investment bank who not only help arrange debt but also equity, we think that it will be interesting to see how the listed shipping names will react going forward when the underlying market improves. You have a better rate environment, but at the same time, the lack of availability of traditional debt means that their S&P activity is not going to be as high. So we think that's going to be interesting to follow.
Maureen, your thoughts?
Yeah, so basically Standard Chartered Bank, traditionally or historically, it is a trade bank. So shipping finance is always a focus of this bank. And this is a strategically important part of the business. Standard Chartered Bank has done shipping finance for more than 10 years now, and it is still a focus for us. We have seen a few banks coming in, have seen a few banks leaving this industry, but we are still here. We are here for good, as always. In terms of lending volumes, back to your question, I think looking at the data point, looking at the data at a certain point might not be reflecting the factuals, because there are a lot of one-off factors affecting those data points. But in general, I would say this year our appetite will be bigger than last year. And I think I totally agree with James. We will focus more on the cargo owners. So I think, especially for this year, our new strategy is to focus on the shipping finance transactions that are providing clients that is not highly correlated with shipping industry itself, so that we are not concentrated in the volatility of this industry. Our client, so if they have the ability, they have a diversified business to weather the cyclicality of the business, of the shipping industry, then their risk tolerance, their risk resilience is much stronger. Those will be the clients we're focusing on.
Mm-hmm. Thank you for that. Along those lines, I think if we can peel back the onion layers a little bit and dive a little bit more into the nuances of the types of deals that you are looking into. I was going to ask about sort of non-performing loans and de-risking the lending books, but we will skip that question. And perhaps we can dive into sort of, Logan, you had already mentioned of sort of the conservative nature of BNP and looking at the deals, but the volume is, you think that the volume will be there. And then certainly, James, you alluded to the fact that the devil's in the details, right? So let's see what those details are. Are the types of vessels that you're looking at in this market, sort of the typical loan spreads, the pricing, without giving any specifics, but sort of your feelings about where you see the advance rates treading, just a little bit more diving into sort of the nuances of what you're seeing in the market and what your seeing within your respective institutions, especially for the uninitiated, when you're talking about it in sort of macro terms, it's hard to visualize sometimes what that means. Darryl, if you can kind of share your thoughts on sort of the types of deals. I mean, we assume they're all secured, but perhaps there are some unsecured deals that you may be looking at with certain credits. So if you could share some of your thoughts on what you're seeing.
Okay. Do you want Logan and the rest to start first, or?
Should we start from the other end and work way back?
Yeah, sure. For asset types, we will still focus on the liquid asset types, because as a bank, we want to make sure when we need to enforce the asset, we have the ability to do that. Well, we are not expert in this part, in this field, so we want to make sure the assets are saleable assets. But in the meantime, we are also very interested in the offshore production units, for example, FSRU, FPSO, FLNG, those kind of assets, but of course with long-term charter. So we need, for these assets, of course, you are not looking at the asset itself. You're looking at the cash flow, the underlying cash flow, and also the credit, how should I say, the counterparty risk of the cash flow that is coming from. So these will be the assets we will be focusing on. For offshore, for pure offshore exploration assets, we will still be a bit cautious, but if there is good long-term charter backing up the project, I think it is still good project that to be worked on. Yeah.
Nicolas.
I think we see that in general there's quite little appetite for oil service for most of the traditional lenders. On the other hand, from credit investors, we do see that there is appetite for some pockets within the oil service space. We did a $475 million bond for Flotel last year. That just shows that there is appetite out there even for that kind of asset. We do see more and more. I agree with Maureen's point on people having focus on liquidity or liquid types of assets, commoditized assets. On the other hand, the whole sort of green shift that we're seeing, I'm based in Norway, and there's a very strong movement towards hybrid and electrical powered vessels. We have a lot of our ferry infrastructure is now either hybrid or electrically powered. We see that there's a lot of appetite actually also from Asian institutions to participate in financing that type of vessel. And that, I think is maybe the most interesting change. There will probably always be lending appetite and capacity for commodity shipping, but I think it's more interesting to follow some of these new trends, because I think you can attach things to that type of financing, which makes it even more competitive. For example, you have credit investors in Scandinavia that say that if a certain percentage of their portfolio needs to be green, and if they can accomplish that, they can come in with a bond that's substantially lower priced than if you're talking a similar credit, but for a non-green initiative. So I think that's an interesting trend that we're seeing.
Mm-hmm.
For us, we are pretty asset agnostic, except one type of ships that we do not finance will be ferry. We go for ocean going, but the whole point is because we do not looking at it as a liquidating factor that the asset will be on our hands. In fact, we look at the business model itself. The underlying business model is very important for us. If you listen to the previous panel, they are all listed company. They actually can come into the market and do quite different deals when the other owners might barely get shipping finance. They'll be able to get a revolver. They might be able to get a second-hand refinancing. So I see that this is a very important for ship owners in the future to be able to diversify their source of funding. And I do think that a lot of Asian players are not necessarily listed. I think that constrain them from borrowing from traditional shipping bank, I think that would be an issue from that perspective. In our portfolio, we see that number of Asian players are now going to the capital market, particularly on the project bond basis. We're talking about this offshore with long-term charter. Even though with long-term charter, I don't really think that commercial bank will be able to provide a 10 of 20 years or 30 years, but instead the capital market would do so. We see a lot of Western player already going into that angle, probably because they could not borrow it from the traditional European banks. So they have to attempt go to the capital market. But in this summertime, you will see a couple of pure Asian players going to the project bond market, and they could secure like something up to 20 years. And a lot of them are financing are provided by commercial bank and now being taken out by the capital markets. So this is what I see for those clients that who will be able to raise funds. They will continue to diversify their source of fundings.
Logan.
Yeah. For BNP, in fact, if you look at my name card, shipping actually in the investment banking division, we do, in fact, we have, I think we are the only bank in Asia that have shipping sector in investment banking. So we do one stop shop for our clients. So well, we do traditional financing, and our financing ratio is from 50% to even 90%. And sometimes we package, arrange 100% financing for our clients. And we do project bonds and also tax leasing, JOCO, French tax lease, all that can actually enhance our clients' borrowing costs. Yeah, but particularly if you also look at our logo is green. So now the hottest topic is green financing, green shipping. So we very much promote green shipping loan, green shipping bond. So that is something that we promote very strongly nowadays. And but I don't know in the Norwegian market, because in Asian market, if a green bond, it doesn't mean that you will lower your borrowing costs. In fact, it's the same. And additionally, maybe you have additional costs because you need to have the consultancy agents to give you opinion, the green opinion. So this is additional cost. The only benefit you can get is a reputation. That is a CSR, that is a corporate society responsibility that you can gain from the market, from your regulator, the society, government. So that is a reputational gain. But no additional benefit or your borrowing costs. But however, if on green loan, or what we call is some incentive side loan, that some banks, particularly BNP, we can contribute, we can lower our borrowing costs, in order to contribute to the society. That is something that is from our top management. If not a green loan, then that is normal price. If a green loan, we will reduce certain percentage of margin. But I cannot tell you now because this is a commercial secret. Yeah. So, but it doesn't mean that we don't do non-green loan. We do everything. So, but we promote green loan quite a lot. Yeah. Thank you.
Okay, for ABN, we are like Citi, we are sector agnostic when it comes to asset classes. For us, the main, one of the main criteria we look at when it comes to financing is how our clients manage their business, the management team behind, the track record. So from a sector perspective, we are less particular about it. But at the same time, we would prefer asset-going vessels, commoditized assets that is a bit more liquid. We, well, for now, tend to be a bit more conservative on the offshore supply market, and we also have traditionally not financed cruises.
I want to switch gears just a little bit here. I know we appreciate the thoughts on sort of the appetite and the types of deals that you guys are and the banks are looking into. But I want to talk about relationships. I mean, I don't think anyone in here will say that relationships don't matter anymore. is clearly a relationship-driven business. Relationships do matter. But I think what we've learned in the last handful of years is that the profitability, the numbers have to back up those relationships. The days of just automatically going and relying on that relationship for the loans, I think, is pretty much over, in the sense that you do actually need the numbers to back up sort of the long-standing relationship that you may have had. So to what extent has your views on relationship with your clients and how you address those relationships, how have that changed recently? Maybe we'll start here with Darryl. Yep.
Okay, for us, relationship is key. So if we see an opportunistic deal that gives very high returns, but we don't see a relationship angle, or we don't see a potential long-term relationship with the client or prospect, then we would not do the transaction. So on the same token, if we are looking at a relationship, like G says, the economics have to stack up. Of course, from time to time, there would be transactions that would be below hurdles, but on a long-term sustainable perspective, the numbers need to work. And I think most clients understand that. They are very happy to help banks achieve their hurdles or their targets whenever it makes sense, because it has to be a long-term sustainable type of relationship for both parties. Mm-hmm. And I think for most of our clients, that has worked very well.
Logan, do you share that sentiment? Or?
Yeah, definitely. We are actually a relationship bank. We will not just do one-off deal, hit and run. No, we want to bank with our client is to grow, to have a long-term relationship. And definitely, if you are our existing client, that is much easy to get deal done, credit approval. But for new client, that will take a longer time, that we will need to do due diligence, and our risk people will have to take a look whether how good the company, the client is. So definitely, existing relationship will help for credit approval. And for pricing wise, that also help, because we try to do business. It's not just pure pink vanilla shipping loan. We like to do financing and other stuff with our client in all dimensions. So we will have a lot of cross-sellings. That's why we can do bonds, ECM, DCM, and any other products, cash management, all that. So trade finance, that definitely will help the client revenue. Overall. So while maybe we lower our pricing margin on the debt shipping loan, but we have the IPO mandate and EB, CB mandate, that will help. Yeah.
James.
We have very stringent target market criteria, so we haven't really changed much of our portfolio since probably 20 or 30 years ago. But having said that, during the crisis time, when some of the banks were retrieving from the market, I think that was a time we could actually get into names that in the past we would not be able to get in and build a very good relationship. In fact, it's during the downtime we build sustainable long-term relationship with those clients. And we also see that, as I mentioned before, we're focusing on more cargo's owner too. There are a number of names, they might not be traditional shipping names in the past, but then they have been our relationship on a global basis. Then we'll be able to do so. And when it comes to structured solution too, we also work with leasing company. It's not easy because it is considered as a financial institution, so it would take quite an effort to really get our credit committee to be comfortable. But once you've done a deal, that will be a repeat. I think this is the part that makes that a little bit probably I think actually the same as any other banks nowadays. If there were lots of banks coming to the market, there should be syndication. I don't see any syndications for shipping finance a lot. focusing on a few names, then all the banks will be going in there. So all in all, it's just a shift of these markets, and it will no longer be going back to the pre-crisis. That would be the future going forward, at least in the next 5 years or so, I would say.
Nicolas.
Yeah, I think what Logan just said very clearly illustrates what I was about to say, which is that from where we're sitting, which is again a bit coming from the outside, we very clearly see that although all the banks claim that they're still very much relationship driven, that comes with some strings attached, because most of the banks that we have some kind of working relationship with, or the lenders we have a working relationship with, are under a bit of pressure to increase their return on their shareholders' equity, basically. And that means that, you know, when you're lending out to the tier one clients that everyone's chasing at, you know, falling margins, you're not going to be able to make those, to meet that improvement on return on equity. So what happens is that things like ancillary business becomes much more important. I have a good example that I don't want to mention by name, but we have a client that's ordered some dry cargo ships. It's a standalone company. We would have thought that they would have struggled to get debt financing, but they achieved L plus 250, 18-year profile, and roughly 60% LTV from a traditional lender, which for a company with, you know, less than 10 assets, I think is extremely aggressive financing. They wouldn't have achieved that if it weren't for the fact that there are shareholders in that company that are extremely active in the capital markets with other portfolio companies. And so I think the banks see an opportunity to lend out at a not so interesting margin on one hand. On the other hand, they know that they'll get the favor repaid with investment banking mandates and cash management, FX, all these things. So I think that is very important. So to just say that banks are relationship driven today, I think is not really accurate. I think it's a much more complex picture than that.
Maureen, your thoughts?
Yeah, I think, well, first of all, we are relationship banks. And I think for most banks who just enter the financing industry, probably they will focus on profitability. But over the time, you need to focus on relationship, and we look at the overall relationship return. Well, for us, most of our clients, they are not just focused on a business in one particular industry, in one particular country. Our clients, they will have business in Southeast Asia, in Africa, in Middle East, in Brazil. So we also have people there supporting them. So we look at the overall account strategy from a global perspective. So of course we will focus on a overall relationship-driven return. And in the meantime, to echo what Logan and James have mentioned, so for clients we will look at their business model. But I think one fundamental thing is the reputation. So over the time, the client that has good reputation, they will have the respect from the banks, and they will also benefit from that over the long time. Yeah.
In the last couple minutes that we have, I want to touch upon what Nicolas was saying about the ancillary services. I think that is starting to become a key component of a lot of the banks in light of the margins decreasing. I mean, it's sort of a reality that you're going to have to offer up something in addition to something plus, right? I don't want to spend the time going down the road here, but if anyone has additional thoughts, I know Nicolas, you kind of started us on that path anyway, but James or Logan or Darryl or Maureen, if you want to chime in on some of the ancillary services that you have seen or offer up.
If I can just add a quick comment, you know, if you look at DNB, who I don't believe are represented here today, but they have traditionally been one of the largest lenders in shipping, and they have been quite openly, you know, been winding down their exposure, partially by, you know, not refinancing maturing facilities, but also through, when offering financing to people, doing so at margins that they know are not competitive relative to their peers. And I think for the lenders that have a large investment banking arm like DNB, you have this situation where for many years you've been used to getting investment banking or ancillary business back on the back of supporting the companies with debt. If you're no longer in a position to support the companies with providing attractive debt, you no longer have as good a negotiating hand when sort of trying to win beauty contests and come in on ancillary business. So I think that's going to be quite interesting to follow for some of the large banks that have both services in the shipping space.
Maybe I just share my observations over the last 2 decades of financing, what I've seen in the past that it might be applicable to nowadays China, or maybe where the finance-centric is happening when a lot of owners come to the market and look at how vibrant the leasing companies have become, and at the same time the commercial banks have to be part of that too. If they could not lend it directly, they could through the leasing company lend it to their clients. I think one observation I have seen that I'd like to share with the audience is the Korean market. Korean market have been the leaders in terms of the shipbuildings and also ship finance before the financial crisis, I have to say. One structure particularly stuck in my mind was when we were in the Korean market, we always see junior loan and senior loan. I think a lot of us have done that in the past too with fellow bankers. And I did mention about that, the junior loans particularly. At that time, most of the Korean company would not be able to get the long-term financing nor come up with equity. So they borrowed from the junior tranche, which are the Korean banks. And after a while, a lot of them will be wiped out because whenever there's a market crash, the senior lenders actually get bailed out. They get first way out, they cover by the asset. It ends up having the junior loans lenders that they have to absorb the losses. And I'm hoping that it would not be repeating in this in this region again, because I think when we are competing too fiercely, sometimes we overlook the quality of the shipping asset or shipping clients itself. In fact, that would creating a bubbles in that sense. We are chasing too little deals, but then we have to expand our market in order to keep our revenue. I think this is the part that what I see a lot of companies coming here to borrow from the leasing company. And I think that I'm sure that they have got very good stringent credit processes. I think this is important to share with them that what I have seen, and that end up the Korean banks are no longer really helping the Korean companies for financing. I think probably the situation might not be the same, but I think it's worth to be able to share that with the audience in here, that so that particularly when we are going to the next century of new financing for new ships, when we know that there are high overcapacity in a number of the sectors, I think collaboration is more important than competitions. And I think it's because of the less competition amongst banks too. We talk to each other even more, and for good clients. And sometimes we do have interesting clients that we might not be able to swallow. I think it allows us to talk to each other more of what we can do, because no one wanted to have a bad loan nowadays. Thank you.
But James, you so far haven't cooperated with me yet.
Really?
Yeah, yes.
But I did a lot with BNP in the past.
Well, since James talked about the last decade's Korean ban, but I don't think Chinese leasing company are doing the same here. First of all, they are the title owner of the ships, and I know them, they may give a higher leverage ratio, 80%, 85 or 19, some 100, the operating lease. But I can see that the operating lease, they praise or they underwrite all to very good charterer like BP, Shell, or that, or MSC. So it's quite different in the old days of the Korean banking market, because they are doing the same for the Korean client itself. It's not have third-party charterer. So I can see the model here is more robust than the past. And certainly for traditional banks like Citi, Standard Chartered, ABN, and of course BNP, we will not compete seriously on the financing ratio leverage, but we may compete on pricing.
Well, on that note, I think our time is up. I think, Logan, you and I, we missed the memo about wearing the orange ties today. But thank you for your attention today, and thank you for the panel. I thought the information was fantastic. And please, if you have any questions, approach any one of us here, and I'm sure we'll have to continue the dialogue.
Yeah.
Good deal. Thanks.
Thank you very
Thanks.
much. Thank you.